Welcome, everyone. We're just going to give everybody a few seconds to jump in here. Thank you for joining us today for the webinar. We'll get started shortly. Good afternoon, everyone, and welcome to today's webinar hosted by Elevate Wealth Advisory. My name is Brian Rosso, Wealth Advisor and Director of Operations here at Elevate, and today I will be your moderator. Founded in 1982, a little bit about our firm. Elevate is a dedicated team of financial professionals based in Athens, Georgia. We're committed to providing personalized and holistic wealth management services to help you confidently live your best life. We believe that your scarcest resource is your time, and we strive to help you make the most of it. And for today's webinar, we're going to focus on some key financial data regarding tax updates and changes for 2025 tax year. So staying informed about these changes is critical for an effective financial plan, and it also ensures that your strategies are going to remain aligned with those current tax laws. So today we are pleased to have with us Deanne Rosso, the President and CEO of Elevate Wealth Advisory. And Deanne has been with the firm for nearly 20 years. This is her 20th year anniversary year. So congrats on that, Deanne. Working her way up through the ranks before purchasing the firm and assuming leadership in 2019. Although Deanne is a wealth advisor, she wears many hats here, and she's also the visionary behind Elevate and has really focused on building a deep, well-rounded team to deliver the highest level of personal wealth management and financial planning experience. Deanne, thank you for joining us today, and I'll let you take it away.
All right. Thanks, Brian. I'm glad to be here with all of you who are out there on our webinar today. And wow, I mean, when you say, I've been with the firm 20 years, that really feels like, it feels like a long time, but in reality, it doesn't feel that long. 20 years has really flown by here. I guess it's one of those things when you love what you do, you don't feel like you're at work. And so we are grateful to work with great clients and great people and just have a great team. So I've loved my time at Elevate and look forward to maybe the next 20. But Brian's right. Today, we're going to focus on key financial data for 2025. So to do that, I'm going to share my screen. I'm going to share with you guys what we affectionately in our office call our tax card. And let me get my view set up correctly here so that I can zoom in and show you guys the numbers. Today, we're going to talk about a lot of numbers and a lot of things tax related. And so a lot of times people ask me like, why are you focused on so much tax stuff? And it's because as investment advisors, as financial planners, one of actually our primary job is to help you focus on what you can control. We know there are tons and tons of things that we can't control. We can't control the weather. It's really cold in Georgia today. We can't control, Mother Nature, world events, the political scene. We can't control a lot of the things that come at us every single day. So what are the things that we can control? And in our role, our job is to help you control those things, which are cost, risk, taxes, and your choices or behavior. You get to choose who you work with to manage your finances. You get to choose a lot of the, you make your investment selections and, you have lots of things, lots of choices to make. And sometimes those choices are easier to make than others. So one of the things that I mentioned that we have some level of control over is taxes. And not all the time, but we can at least be informed. There's a famous quote by Judge Learned Hand that says, in America, there are two tax systems, one for the informed and one for the uninformed, and they're both legal. So we want to make sure that you are on the informed side of that because that helps you make better decisions and better choices when it comes to your money, your income, and how much of that you allocate, if you will, toward taxes. So with that being said, I'm going to dive right into key financial data for 2025 and just give you guys an update on what stayed the same or what has changed for 2025 with some of these numbers. So I like to start Brian, I believe, is going to drop in the chat box a copy of this key financial data card. So you can download that and have that for your own reference at home if you want to follow along. All right, I like to start right here in the middle on standard deductions. So let me zoom in here. So what do I mean when I say standard deduction? The simplest way I can explain a standard deduction and the way I like to think about it is the amount of money that you can make in a year without paying taxes on it. So, to look at standard deduction, filing status, married filing jointly, this year the standard deduction is $30,000. That means you could make up to $30,000 and not pay any income tax on it because you get to deduct that right off the top. That has increased a little bit this year. So that's all the numbers actually that we're going to look at today have increased by about 2.8%. To put that in perspective, Social Security gives cost of living adjustments every year, and Social Security's cost of living adjustment for 2025 was 2.5%. So everybody that is on Social Security gets an extra 2.5%, like a bump, a raise this year, if you will. So when I think about that in terms of standard deduction and some of these numbers, I think, okay, that's an extra 2.8% that I can take in income this year and not pay tax on when it comes to my standard deduction. So standard deduction is $30,000 for a married filing jointly client this year, $15,000 if you're single or married filing separately. Um, Also, there's additional deductions for non-itemizers. So you get to choose on your tax return whether you take the standard deduction or whether you itemize. Itemize means I would take some of my bigger expenses like state and local taxes, mortgage interest, charitable deductions. And if all those things add up to more than my standard deduction, then I'm going to be an itemizer. I'm going to itemize my return. The Tax Cuts and Jobs Act of 2018 made it so that it was supposed to simplify the tax code. It did, but one of the main ways that it simplified it was it doubled actually effectively at the time, the standard deduction, so that fewer of us itemized or had to keep up with those itemized expenses to deduct them. So now I would venture to say that at least most retirees or most retirees that we see take the standard deduction. And then it's kind of a toss up for a lot of working individuals, whether or not they itemize or take the standard deduction. And it really depends on, what's your state and local taxes? How much do you pay in property tax? There's a $10,000 cap on that as far as what you can deduct. And then how much do you give to charity? And do you have mortgage interest? Those are the big three things for itemization. So that's why I start with standard deduction. Do you take the standard or do you itemize? And that just depends on where you are in your life and what type of itemized deductions you have. But just so you know, this year, for those of us that tend to just take the standard deduction, we get a little bit more in standard deduction that we can take this year. The child tax credit did not change this year. That's still $2,000 that you get as long as your income is less than 400,000 joint, married filing jointly, or $200,000. If you have a child under the age of 17, you get to take a $2,000 tax credit. So, and that did not change. That amount did not change from 2024. Okay, so standard deduction, we've covered that. Let's move on over. Sorry for skipping around here. Let's move on over to tax rate schedules. So in the US here, we are under the marginal tax rate system. And what that means is we don't pay the same amount of tax on every dollar that we bring in. So let's focus for a minute on single and married filing jointly tax brackets. Let's scroll on down here. So our tax rate changes based on the amount of dollars that we earn. So if you're single, and this is in this category also, this is taxable income. And what do I mean when I say taxable income? I mean the income that you brought in minus your standard or your itemized deductions. So that's why it was important for me to start with standard deduction, because let's just talk about standard deduction for a second. If you make $40,000, the first 30 you get to take off and not pay any tax on. So it's only that next 10 that you would pay taxes on, and then you would pay that at the marginal tax rate. So if you're single and you make zero, which effectively is $30,000, I'm sorry, 15.5 if you're a single individual, to 11,925, you pay 10% tax on those dollars. And then once you bump up to $11,926 on that $11,926 up to 48,475, you would pay 12% on those dollars. So that's what I mean by a marginal tax rate system. So this year, what has changed over last year is we did get an increase in our marginal tax brackets by about 2.8%. So that means that not only from a standard deduction standpoint do you get to deduct about 2.8% more dollars tax-free, but you also get to take about 2.8% more dollars in the tax bracket, in your lower tax bracket. So you've got an extra 2.8% before you jump up to the next marginal tax bracket, if you will. I know it's really confusing. And when we think about taxes, generally we think of it as an effective rate or a blended rate, like what amount of tax did we pay on every dollar we brought in? And you have to calculate that blended rate by knowing what your marginal bracket is. But it's important to know what your marginal bracket is because that way, let's say that this year or you got a raise and that as married filing jointly you were at $95,000 of income, and this year you're going to be at $97,000 of income. It's important to know that you're about to bump up to the next bracket, and on those dollars over 96,950, you're about to pay 22% in federal tax rather than the 12% you have been paying. This catches people off guard sometimes. Sometimes it's tax time. We're doing our tax return for last year, and we realize that we owe more tax than we anticipated, and it's because we happened to jump up in the marginal tax bracket and we didn't realize it. So knowing where you sit for your marginal tax bracket is important. It's particularly important for retirees because when you're on a fixed income or you're taking withdrawals from retirement accounts that are fully taxable, every single dollar that you take in an income that's fully taxable can affect a number of things. It can be a domino effect, but one of those is your marginal tax bracket. Does it bump you up to the next bracket? Or are we trying to manage to stay within a certain marginal tax bracket? And that's retirement income planning on a different level that we won't have time for today. But just know that these are the numbers that we're using to figure out and try to help our clients figure out what marginal tax bracket are we playing with? Are we staying within? All right, so that's marginal tax brackets. Next, let's go over to the middle of the card, which is long-term rates, tax rates on long-term capital gains and qualified dividends. So what do I mean by long-term capital gains and qualified dividends? If I hold a security, a stock, a bond for longer than a year, I've held it long-term. And if I have growth on that security in just a regular plain, what we call a plain vanilla investment account, then when I sell that security, I've generated a capital gain. I've realized a capital gain. And those types of gains are income to us, but they're income that's taxed at a different rate. That's your long-term capital gains rate. Also, qualified dividends, if I own a stock, for example, that shares its profits with its shareholders in the form of dividends. Many times those are called qualified dividends, and they get the same preferential tax treatment. So the way that your capital gains are taxed is actually based on how all your income fits together. So your working income, your IRA or 401k income, plus the amount of gain that you realized as income when you sold that security, add all that together, and that's going to put you into, and then minus your standard or your itemized deduction, and that's your taxable income. And that total taxable income, if it is less than 96,700 joint or 48,350 single for 2025, you pay zero tax on those capital gains and dividends on that income that you took there. So that's very favorable. So how does that impact us? Well, obviously, if we have a client that their income is falling below those levels and they still have room, they have more room in that bracket, if you will, we want to harvest some gains so that they pay absolutely no tax on those dollars. But also, if we jump up to the next level, 15% is still a very favorable rate for long-term capital gains and qualified dividends, less than the 22% bracket that we see for a lot of working individuals and or retirees. So if you're and in fact, it's if you are below $600,050 in joint income or 533,400 taxable income as a single individual, that's a lot. It's a lot of income you can take and still fall into a 15% capital gains tax rate. So a really smart strategy, whether you're working or retired, but a lot of times we employ this for retirees, is let's make sure that we utilize long-term capital gains as a part of our income strategy because we get such a favorable tax rate on doing so. And to do that requires some pre-planning, as you can imagine. We have to make sure we're saving the right amounts in the right type of accounts so that later on down the road, we can take advantage of these tax brackets. Again, another conversation for another day, but just to let you know, this is how taxes on long-term capital rates and qualified dividends work. And a lot of times it's a preferential tax rate to your ordinary income. All right, let's go on over to gift and estate tax exclusion amounts. We get a lot of questions about this, and we actually have videos about all of these things on our YouTube channel in little bite-sized pieces, bite-sized chunks instead of all at one time in like a long webinar. So if you're interested in learning more about some of these specific topics and just a little bit at a time, you can find lots of videos on our YouTube channel, Elevate Wealth. But gift and estate tax exclusions and credits. So um, there is a federal estate tax. And what I mean by that is the amount of money that you can leave to your heirs is limited until a tax rate takes effect. However, that exclusion is really high. So right now, any individual can leave to their estate $13.99 million before we're worried about that potential 40% maximum gift and estate tax rate. So it's really high. I'd love to be in the category where this impacts me. I think a lot of people would. However, most of us aren't impacted by it. But what we get a lot more questions about is this gift tax annual exclusion. How much can I give to anybody in a year before the gift tax comes into play? And so 2 points I want to make here. The first point is this year you can give $19,000 individual to any other individual. Let me back up for a second. Transfers between spouses this does not apply to you. You can give as much or as little to your spouse as you want, and you don't have to worry about gift taxes. But if I want to give money to any other individual, I can give $19,000 to anybody that I want, and to multiple individuals if I want, without having to report, file, or do anything. Over $19,000, I need to report that gift as a gift. I need to say I gave $20,000. I need to say I gave $25,000 to that individual. And why? And the reason why is because then the amount over $19,000, so if I gave 20, the extra $1,000 is going to go against my eventual estate exclusion. So then I've just knocked it down to $13,989,000, the million dollars, instead of having the full 13,990. So there's not really a tax on additional gifts over $19,000 now. It just reduces what I have in the future for my estate tax exclusion. And that's why those gifts need to be reported if they're over $19,000. But there's still a lot of, you got a lot of bandwidth to work with gift taxes, because let's say you wanted to give a gift to your daughter and son-in-law, you could give them each $19,000, or to your daughter and son-in-law and their 2 or 3 children. You can give them each $19,000 as a family. And so there's still a lot of potential for making larger gifts without having to worry about the gift tax exclusion or reporting that gift. So I hope that does a decent job, at least, of explaining gift and estate tax exclusions. In the year 2025, not much has happened with education credits, deductions, and distributions. Pretty much the same. Tax credits for American Opportunity Credit, Lifetime Learning Credit. The one the one thing that has changed is just a little bit more joint income that you can take if you use savings bond interest tax-free for education. So you can use savings bond interest tax-free if it's used for education and if your income falls under a certain amount, which in 2025 is 149,250 joint, or in all other tax filing statuses, 99,500. And then lastly, on the front side, I call it the front side of the card because we have printed cards that we use. Literally, I use this every day in the office and I look at it all the time. So I'm very familiar with what's on the front and what's on the back. But tax deadlines are here. So what do you need to keep up with as far as your tax deadlines go for this year? January 15th, we're just beyond that. But that was the fourth installment of last year's estimated taxes. So looking ahead, of course, April 15th is our tax filing deadline or the deadline to request an extension to October 15th. Also, April 15th is important because you still have time to do things for last year. Some things, if you want to, like make IRA or Roth IRA contributions, make education savings accounts like 529 plan contributions for last year. You can still do all of those things, and health savings account contributions. You can still do all of those things for 2024 up until you file your tax return or April 15th, whichever is later. And then, with like SEP plan, simplified employee pension, that's an employer plan. If you extend your return, you have until October 15th, or the due date of your tax return, to make those type of contributions. So April 15th is a big one. You got lots of words here on this category, but that one is really the deadline for doing a lot of things from last year. And then, of course, we've got our estimated taxes due June and September. October 15th, tax returns due for extensions. And then, gosh, December 31st, which always comes too quick for all of us, is trying to get in all of those things before the end of the year that you can't do beyond December 31st. So pay expenses for itemized deductions, things like make sure that you made your charitable deductions and that those checks were cashed. Complete transactions for capital gains or losses. If you want to do what I mentioned earlier about harvesting some capital gains, got to do that before 12/31. Funding like 401k plans for that year. In some ways, there are deadlines attributed to the end of the year. So that's your tax deadlines to pay attention to for 2025. So I'm not sure that Brian mentioned it at the start, but if you have any questions as I'm talking, you can feel free to put those in the chat box. And if we have time before our webinar time expires today, I will try to answer some of those questions because I know I'm really flying through this content. So let's flip over to the back side of the card. And we're going to just start at top left, which is retirement plan contribution limits. And so now I'm shifting my thinking into more of what do I need to focus on for 2025? And one of those things is, if you are in your working years, your earning years, are you contributing to your retirement accounts? Very important in our society today to make sure that you're paying attention to that three-legged stool of retirement income, which is your Social Security, your earned income, your individual savings, and then those plans that are provided through work. So when we have all the legs of the stool accounted for, it makes retirement income planning a lot more effective. So to put that in perspective, let's talk about retirement plan contribution limits. I'm going to just go on down this column to 401k, 403b, 457, Roth 401k plans, elective deferrals. So this year, you can contribute from your paycheck if you are eligible for a 401k, 403b, 457, Roth 401k, $23,500 from your paycheck as salary deferral. And that is up $500 from last year. So we get a $500 increase in what we can save. So quick tip, if you did get a raise or a bonus, I always say start the year by taking at least some of that raise or bonus and bumping up what you're adding to your retirement plan to make sure that you're accounting for that savings, saving a little bit extra on that raise, because later on down the road, when you retire, You're not going to retire on today's income. You're going to retire on that day's income, which is going to be a lot higher than today, probably. So take a little bit of time to assess what you can feasibly save and increase that elective deferral amount. And the IRS has increased it for us a little bit. If you are maximizing your elective deferrals, you can do $23,500 this year. On these plans, there's a catch-up provision. So if you're over age 50, you can add extra salary deferral in order to help you catch up those retirement savings. And that level this year is $7,500 that you can add to that $23,500 to get you saving the max for in your retirement plan. Also simple plans. So if you are in a small business with a simple savings incentive match plan for employees plan, you can contribute $16,500 from your salary. That is bumped up a little bit by $500 this year, and then your catch-up contribution stayed the same at $3,500 for this year. If you are a business owner and your 401k plan is designed to help you maximize your savings, that's where this top line here comes into effect, the annual contribution, annual compensation used to determine contribution for plans. So only your first $350,000 of compensation is used to calculate your match and your profit sharing. So that is an increase by about $5,000 this year. All right, moving on down to IRAs. Interestingly enough, the Roth and traditional IRA contribution limits did not change this year. So we're still at $7,000 for traditional and Roth IRA contributions. We are still at $1,000 catch up if you're over age 50. So a total of, if you're over age 50, a total of $8,000 that you can contribute. And then there are some income limits that are imposed on those things. So if you want to add funds to a traditional IRA and not deduct it on your tax return, no income limit and really no rules. You can put $8,000 in there, no questions asked. If you want to deduct that contribution, then you have to be in these income levels. If you are covered by a 401k or a simple or a SEP, if some type of retirement plan, you have income limits that would allow you to, or disallow you, I guess, from making a maximum contribution to traditional IRAs. And then with Roth IRAs, there is an income limit. So up to $246,000 in joint income will effectively kick you out of being able to contribute to a Roth IRA. And then Roth conversion, there's no income limit for conversion. And what do I mean by conversion? What I mean when I say that is, let's take some money from your IRA and move it over to your Roth IRA. But when we do that, it's taxable to you. Why would we ever do that? Well, we would do that if your tax rate, we thought today, was going to be lower than tomorrow. Then let's go ahead and volunteer to pay some tax on those dollars to get them in a place in a Roth IRA or a Roth 401k where there's no tax on those dollars ever again, and they're allowed to grow tax-free as well. So lots of reasons to do Roth conversion. It needs to be part of your strategy for savings and for retirement income if it's not. And just as an example of that, I'll go ahead and flip over to, I'll move away from this for a second and show you guys our tax buckets, because I've talked a lot about saving for retirement today and then how we take income stream. And we affectionately call this our tax buckets because this is the 3 types of buckets you can save money in and then how they come out in retirement. Tax deferred on the left, of course, we have IRA, simple SEP, pensions, your 401ks. Those monies go in pre-tax. And then when they come out, they're at your ordinary marginal tax bracket that we talked about earlier. On the flip side, on the far right, you have tax-free, and that's going to be your Roth money. So it goes in without having paid tax on it. I'm sorry, it goes in after you've already paid tax on it. So if we did a conversion, for example, those dollars go in after you've paid tax on it. If we make Roth IRA contributions, you don't get to deduct that on the return. It goes in after tax, but then it's allowed to grow with no tax on the growth. And when it comes out, it's never taxed again. And then there's that middle bucket where we talked about capital gains, qualified dividends, where you pay tax only on the growth of those dollars. Money goes in after tax, it grows. And when you decide to sell those securities in order to generate income, then they're taxed at that middle, that qualified long-term capital gains and qualified dividends rate, which is a lot of times an advantage to your ordinary income tax rate. So that's why I stress so heavily saving across the three buckets. Let me go back here and why I decided to talk about it right there, because you have limits to what you can go in your traditional IRAs and your Roth IRAs, but you have to also be mindful of the income and how it's taxed now and how it might be taxed for you later. So health savings accounts. A health savings account is the most tax efficient account that you can own. If you have the ability to add to a health savings account, I highly recommend it. So when we looked at the tax buckets just then, and we looked at the right side, which was Roth IRAs, and we saw that money goes in after tax and then it comes out tax-free. A health savings account is like the best of all worlds. The money goes in pre-tax, and then when you take it out to spend it for medical expenses, it's also tax-free. So there's absolutely no tax, and all that growth that may happen inside that account, you also get tax-free. So it's not enough just to, if you want to use this as sort of a retirement saving strategy, what you want to do is you want to, well, first of all, you have to have a high deductible health plan that qualifies for a health savings account to have one. And then you need to put money into it. Sometimes employers match that as well. And so your maximum contributions did increase this year a little bit. Let's see, that was about $250 for individuals and $500 for families. And there is a catch up of $1,000 per person for over age 55. But if you put the money in, and it's natural for a lot of us, particularly with children, to put money in our health savings account and then to pull it out to spend it on our deductibles and things throughout the year. But if you put the money in and then you invest it in anything from a money market earning some rate of interest to whatever investment options you have available, and then you don't spend it and you let that money add up, you could be sitting on a really nice pool of funds when you retire that you could use to pay Medicare premiums, deductibles, long-term care expenses, a plethora of things, eyeglasses, contacts, drugstore, a ton of things, completely tax-free. So health savings account is an amazing option if you have the ability to have one. And even if your employer doesn't offer one necessarily, if you are in a high deductible health plan, you can open one for yourself. You just have to qualify. So that's my soapbox on health savings accounts. I love them. And if you have the ability to do it, I would do it. Long-term care premiums. So for those of us that may have long-term care insurance that we pay premiums on, based on your age, some certain dollar amount of that premium could qualify as a medical expense. So you could deduct, if you're over age 70 and you're still paying long-term care premiums, so a lot of people are, you can deduct $6,000 as a medical expense. So going back to itemized deductions, medical expenses are an itemized deduction. It's just that now they have to be over 7.5% of your income in order to be deductible. So a lot of the time that doesn't even qualify for us, but you could add that long-term care premium to your out-of-pocket medical costs to see if that might help you itemize your deductions. And then you've got your Medicare, if you're on Medicare, Medicare deductibles, Part A and Part B are standardized. So your Part B deductible this year, $257, and then listed below here are your Part A deductibles if that applies to you. All right, we are kind of coming towards the end. I'm skipping around a lot here. All right, Social Security. This is on the middle of the back side of the card. Social Security is somewhat taxable. And that's always confusing to people, but let's look at that. And the top section of this card is maximum benefit. The maximum possible benefit that someone who is taking it this year could get is $4,018, and that's based on their own earnings history, having made the max for earnings over 30 years, and then with a cost of living adjustment. So it doesn't apply to everyone. It's just an interesting number. If you are retired and you took Social Security early or before your full retirement age, which is FRA that they reference here, you're subject to what's called the earnings test. So you can make a certain amount of money before you have to pay some of it back to Social Security while you're under full retirement age. So here's your exemption amounts for that this year. You can earn up to $23,400, like part-time work or whatever, if you are under full retirement age before you have to give some of your Social Security benefit back. And then the tax on Social Security benefits. This is one thing that didn't change this year, and it hasn't changed in a number of years, which is your tax brackets for how much tax you pay on Social Security. And this is based on your provisional income. Little asterisk here, because they give us the definition down here in little teeny tiny type of what is provisional income. It's your adjusted gross income, not including Social Security. So you could pretty much just go off of add up all your income and take out your Social Security, plus any tax exempt interest that you may have. And then you add back in half of your Social Security benefit or 50% of that benefit. And that is what will give you your provisional income that is then used to determine how much of your Social Security benefit you will pay tax on. So earlier when I talked about if you're a retiree and you decide to take one more dollar in IRA 401k retirement income that's ordinary taxable, this is where the dominoes can trigger higher taxation of Social Security. But suffice it to say that most of us, sorry for skipping around. Suffice it to say that most of us will pay 80 tax on 85% of our Social Security. It's actually really kind of difficult in today's standards, with standard of living and such, to have a low provisional income. It can be planned for strategically if that's important to you. It's just something that kind of would require some strategic retirement income planning during your working years. But otherwise, nothing really changed with Social Security other than what's not represented here, which is a cost of living adjustment to all beneficiaries of 2.5%. So everybody that's on Social Security got a 2.5% raise this year. And then skip on over to the right and final side of our card, which is Medicare premiums. So one thing that we really want to pay attention to for our retirees that are approaching and or at Medicare age is, what is your Medicare premium? And that premium is based on the amount of income you made, not this year and not last year, but 2 years ago. It's based on your modified adjusted gross income from 2 years ago. And so sometimes we get caught in the trap of, let's say that we had some property that we had inherited, that we sold and had a really huge gain on it. And 1 year we took a bunch of income. I can't tell you how many times this has happened. 2 years later, I get a call from a client who says, "What in the world? My Social Security payment went way down this year. And I don't understand. Did they lower Social Security?" And the reality is, no, they did not lower Social Security. They got hit with an additional Part B premium, which comes out of your Social Security if you're taking benefits, because of the higher income 2 years ago. And so sometimes those, we call that is called IRMA, the income related Medicare adjustment amount. And sometimes that can be managed, as in if it's a year that you retired or you had a life-changing event, retirement, death, disability, certain things are defined as life-changing event, then we can appeal that and we can say, no, don't raise our, let's use this year's income for our Medicare premium instead of that 2 years ago income. But there are other certain things like sales of securities or properties or selling of a business that don't qualify for an IRMA appeal, if you will. So we have to really pay attention to when we take income and really know, for example, a strategy we use with our clients a lot, Roth conversions. If we're going to convert a lot of money from IRA to Roth, we need to know how that's going to impact our Medicare premium, not now, but 2 years from now. And so these are our brackets. If in 2023 you made 200 and joint income was 212 or less, then your Part B premium is 185 and there's no Part D income adjustment. But if you made 212,001 modified adjusted gross income, your Part B premium jumps up. And that is a reverse cliff that will send you over the edge and into paying a higher Part B premium just by that $1. So something to pay attention to, your magi from, in this year, then in 2025, what we're thinking about is what's my Medicare premium going to be in 2027. Okay. All right. And then the last part, so sorry for all the skipping around. The last part of this chart is the uniform lifetime table. If you are of required minimum distribution age, so on IRAs and 401ks and 403bs and such, after you reach a certain age, which is now age 73, you have required minimum distributions, meaning the IRS has given you all that tax deferral all this time, the ability to put money in without paying tax on it and let it grow without paying tax on it. But come age 73, they want you to start taking some of it out. And so this is the table where you calculate that you get the factor to calculate your required minimum distribution. As an example, if you turn age 73 this year, you're going to use your IRA account balance from December 31st. You're going to find your factor on the chart, 26.5, and you're going to divide that IRA account balance from 2020 from the end of the last year by 26.5. And that will be your required minimum distribution this year. So you get to choose whether or not you take that required. It is required, but there are hefty penalties, a 25% penalty for not taking that required distribution. So you want to make sure you do it. And one cool thing that you can do, starting actually earlier than 73, at age 70, if you are charitably inclined, you can start giving money from your IRA to charities. If you give it directly from the IRA to the charity, it's called a qualified charitable distribution. Then you don't owe tax on that money. So sometimes this is part of a charitable giving strategy, thinking about what are your required distributions going to be? What's your lifetime giving plan? And should we use those required minimum distributions as your charitable gifts once you reach age 73? So that is a lot of me talking about numbers. And I'm going to stop sharing now and ask Brian if we have any questions.
Thank you, Deanne.
Sure.
Yes, there's a lot that can be done with taxes, and sometimes it can be information overload for a lot of our clients, but it's important that we dive in and really understand the changes that happen each year, and then also kind of develop the plan around those changes. And I really like that we do this webinar in January because it really does help us plan ahead. And a lot of times we do taxes in the rear view, but again, this is a good start of the year. So thank you again for all those comments. We do have a few questions. We have one here about the annual gift tax exclusion. You mentioned for single, you can give one person $19,000 a year, but how does that, or does it extend to couples?
Well, yes, but it's still based on an individual. So I can give 19,000 and my husband can give 19,000. So you can double that up to make a gift to an individual.
Okay, great. All right, looks like that is all the questions for today. I did put in the chat box the key financial data card, so if you want to grab it there, please do so. And if not, please email marketing@elevate-wealth.com and we can get you a copy of that. And thank you so much for joining us today. And be sure to sign up for our future webinars coming up at elevate-wealth.com. And also, Deanne mentioned we have a lot of financial tips. We put out a lot of content over our YouTube channel. So if you'll go to youtube.com and search for Elevate Wealth Advisory in Athens, Georgia, you can find us there. So thank you so much, and we hope you all have a wonderful day.
Thanks, everybody.
Thanks, Deanne.